Hello, everybody. How are you? My name is Ricardo Menjivar. Thank you for having me again one more time. I am the founder of Phoenix Trading Strategies, and today we're going to present to you how to beat the smart money when you trade. Now, when we talk about smart money, many things come to mind. Realistically, the smart money in the industry is known as the institutional money. Where is it going, and why are they calling it smart? Primarily because now most of the trading is being run by algorithms that they've designed in order to implement their strategy and their risk management. So that's what we're going to go over today. So let's continue. Before anything, let's go to the disclaimer. Disclaimer: future stocks and spot currency trading have large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in future stocks and forex markets. Don't trade with money you can't afford to lose. This presentation is neither a solicitation nor an offer to buy, sell future stocks or forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this presentation or website. Past performance indicators or methodology are not necessarily indicative of future results. We got that out of the way. So fortune favors a prepared mind. I've always said that, and there are statements that all traders should live by. One, anything can be accomplished when mind is set to purpose. And two, whatever the mind of a man can conceive and believe, it can achieve. Well, remember that most of these programs have been created by man, not by machine. And so what we're going to really go over is how they have designed in a very hidden format these strategies, which realistically have been around for over 75 years. And all they have done is basically repackage them, rebranded them to some degree, reprogrammed them, and implemented methods that now confuse people and confuse traders. But everything that a man can create can be decoded. Every mathematical formula has a proof. So, and that's what this is all about. It's about math. That's why when I say fortune favors a prepared mind, it's realistically because all this is based on math. And so if we understand that concept, then you'll be able to understand how this can be achieved in this day and age. What does smart trading mean to you? S, specific. As a trader, you're looking for a specific outcome when you trade. M for measurable. As a trader, you must always set goals that are measurable. A for attainable. You must look at every trade with probabilities that can be met. R for realistic. Traders must trade with realistic outcomes, not ones that cannot be achieved. And time. Always be in a trade with a specific time frame to meet your goal. The information that we teach you to use is to be a smart technological trader so that you can stand tall every time you trade to win. Because realistically, that's what this is about. We're talking about how to win, not how to lose, how to manage risk and achieve our goals. And that's what this is about. Why do most traders lose? First, they're using lagging indicators to make decisions, which usually lead to losses. And these could be, moving averages, stochastic RSI, MACD, Fibonacci, Elliott wave, SARS, Ichimoku cloud, you name it. Most of those indicators have now been counter-programmed by the banks. Second, they don't have the correct information to assess the real risk when entering the trade. Why? Because the trade has changed. Everything has changed in the industry. And it started back in 2008. 2007, they began to design these protocols, but in 2008, 2009 is when they changed the whole game and actually implemented them into the trade. Most traders don't understand that decisions are being made systematically now by robots. So how do you outsmart a robot? Well, you determine what its risk parameters and decision protocols are with a program that can decode their intent, because that's what this is about, forecasting intent. Phoenix trading strategies has done that for you. See, trading is like playing a chess game, but if you're in the same frame of mind, you can decode their next 5 moves and beat them at their own game. This picture basically show you that we can demonstrate how you can be in the same frame of mind and understand exactly what their algorithms are going to do next, so that you can see their next move before it happens. See, the one thing that a robot does, or that an algorithm does, is that it does one thing very simplistic. It is very systematic about what it's going to do next. Why? Because their artificial intelligence right now has not been designed to reason. So it can only manage risk. And that's great, because right now they've really done us a tremendous service by allowing us to understand that specific concept, that they are still in development of artificial intelligence to manage and take over the financial industry. This thing started 6 years ago. It's going to evolve further. I give it another 7 years before they can actually develop certain algorithms that can actually reason. But right now, they're not there yet. And so this gives us a good window to actually beat them at their own game. So if you understand how chess is played, basically, chess is a very simple game. It's complicated and simple. Why? Because it requires critical thinking. Well, we do all the critical thinking for you with this program. So it makes it easy for you. Let's continue. Understanding the market makers trade cryptography. Everything is about encryption nowadays. What is illogical becomes logical. What is logical to you, they will make illogical in the trade. So I'm going to show you how that illogical mindset can become your tool, your best friend. And the reason they do this is because they want you to look at trading with fear, doubt, and confusion. But we have the key to their lock and their encryption because we understand their protocols. And so we will show you how not to fear the trade, but instead how to look forward to it every time. And so that you don't fall into making the wrong decision by making a bad trade, when you can actually be looking for the correct trade, and only that trade, because that's the only thing that matters. How do we figure out this puzzle? First, we must understand how their artificial intelligence is programmed and for what purpose. What is ISTP? This is Institutional Systematic Trading Protocol. ISTP is a protocol that is used to program their strategies into an encrypted algorithmic formula. The question that is in everyone's mind is, what are those protocols? They're very simple. There are 4. Portfolio rebalancing, which is based on mean reversion theory. Why do they do high-frequency trading? And 4 components of volume: order flow, volume spread analysis, volume price analysis, and divergence. Now, VSA and VPA have changed, and they've modified it. What Richard Wyckoff did back in the 20s cannot be applied nowadays because they've kind of programmed it. So they've taken specific parts of his theory and made it theirs, and programmed it for their benefit, not yours. So when they say that you should read the taper, to a certain degree, there are certain things that they have programmed for them to read the taper on their behalf to confuse you. So when you're reading it, when you're reading candlesticks, you look at it from a very simplistic perspective. They make it very complicated. I'll show you how to see the simplicity again. Price action. Why is price action important? Because price action, order flow, and volume divergence are the 3 components that make the trade up nowadays. That is what they've encrypted. That is the imbalance that I'm going to show you. What doesn't make sense to you will make sense today. Because for all this time, the trade has been illogical, but it is completely logical to them. But what seems logical to you is totally illogical. And that is why you haven't been able to, some degree, figure out the trade. This is what they base their strategy on. Excuse me. What does our technology consist of? Our indicator runs 4 different algorithms. One, the Forex radar, which basically identifies when there is an imbalance between currencies, and usually the 8 majors. And I'll show you the tool that we use to identify when one currency has been taken out of balance against a portfolio of 8, or when 2 or 3 have been taken out of balance against a portfolio of 8, and when they must be brought back into balance. Power dots. Power dots is an algorithm I'll show you that determines where the high-frequency trading is taking place and at what specific price levels. Now, this is very important because when these dots appear, it's not just a visual. They announce 3 components which are very important: volume, liquidity, and momentum buildup. And that equals a trade. And you'll understand and see why I mean that. The volume price identifier. This one is a very special algorithm that we designed. And this one identifies the discrepancy in order flow. When you look at candlesticks, you look at basically 4 things: the open, high, low, and close of a candle. I'll show you that you can actually see where the point of control is for the buyers and the sellers in the candle. You'll be able to see the price level inside the candle in that specific time frame where they prefer to bid and offer and when they prefer to settle their business, which is basically all the orders that are coming in. Now, that doesn't necessarily mean that that's where they're going to close. That's where the imbalance comes in, and you'll understand that. The volume indicator that we created identifies whether a candle is truly bullish or bearish. And that's a statement that most cannot comprehend because when you look at candlesticks from a visual perspective, if it is green and it's gone up, then it must be bullish. Or when it's red and it's gone short, it must be bearish. Not necessarily. This is what they've done to counter-program candlesticks and to lead you into taking bad trades. So Phoenix Trading Strategies right now is the only software that gives traders of all levels a complete understanding of the market maker's protocols and rules of risk management and trading strategies that they're specifically using right now. Again, these are not complicated rules, but they're very systematic, very logistical to them, and now they will be the same to you. What is portfolio rebalancing? First of all, we must understand that money is in constant motion, but there are parameters that it must maintain. The image on the right demonstrates one of our algorithms that demonstrates what I call currency portfolio rebalancing. This is the Forex radar. Each line that you see is not a moving average. It looks like it, but it's not. It identifies when a specific currency has been strengthened against the portfolio of 8 and when another one has been totally weakened. We look for these anomalies. We look for this specific information when we're trading Forex. Why? Because there are certain time frames which will basically demonstrate what I call a rubber band effect. What is a rubber band effect? That which is strengthened cannot be sustained at that level for a long time. Why? Because it throws the whole portfolio out of balance. So I found this little tool which actually shows you what they do. So basically they take currencies that are in balance, as you can see the yellow and the gray, and then they take them out of balance. They strengthen, they weaken them. This is money in constant motion. And when you see this tool, it makes you wonder, is this really how they have, created their strategy to manage risk? The answer is yes, because it's based on mean reversion. So basically you have a mean, which is the line in the middle. Now, they use moving averages as a mean, and I'll show you why. They don't use a straight line. But this actually demonstrates and gives you a visual understanding of that which goes away from the mean must come back to the mean, and sometimes go right through the mean. It is not a hard concept to wrap your head around, but it's so simplistic that sometimes it makes you even upset that you can't even figure this out. It took me years to really figure this out and understand what they were doing. I'm giving you a quick version of what has taken me 12 years to accomplish and develop. So when you understand this, you're going to realize that understand that trading is no longer as complicated as it seemed. Let's go on to the next slide. This is an example of a trade that I took this week. Now, this trade is on the Dow futures. I got in over here. This was literally 8 hours before the trade actually kicked in. And this was on a 15-minute. Now these arrows actually show where the volume is, and I'll actually bring out the charts to show you later where exactly what the imbalance was. The dashes in between the candlesticks, as I showed you last week, are where the points of control are in the candles. So for instance, this one here, even though this is a bearish candle, shows that the buyers were willing to buy at a lower price. The sellers were nowhere to be seen. Yet here, the buyers and the sellers were offsetting their trades around the same price level. So these imbalances, along with the volume indicator, really identify when you should look for a trade. And this candle right here, and I'll show you in another trade, how it's bearish, but at one point it was bullish and it settled bearish. And this specific candle pattern shows that imbalance, because the point of price action, which is basically where the body of the candle is completely separate of the point of control. This is an anomaly that shows an imbalance, and when demonstrated with volume, it is the perfect entry, because this is what will give you that trade. This is the information they don't want you to understand. They don't want you to see. They don't want you to comprehend, and so they confuse you when it happens because you don't have the tools to actually decode what is actually happening and why it's actually happening. But I'll show you a trade that we took yesterday for non-farm payroll, which will blow your mind. Here's one on crude. I had taken a trade previously here, but this was my second entry. As you can see, this is on a 12-minute. This is where I had volume divergence. So this candle right here was basically the highest point of volume was given here. And then the next one, which was here, you see how it settled right below the 50% line? That made this a bullish candle with negative volume. But I'll show you that negative volume soon. And so it was obvious that if this candle opened up below this one, it was going to go down, and it did. This trade went further than 22 ticks. I actually got out because a client of mine called me on Skype. I was waiting for this because I knew it was going to come all the way down here, and it did. This is how far it came. I got in here. I got out here with 22 ticks. It came all the way down here. It was a full dollar move. Now, I wasn't upset because I missed the full dollar move and I only got 22 cents out of it. I was mad because I knew that it was going to play, but, you know, I had a client call me, and so I don't like to be distracted and be in a trade. So I just closed my position. But it came all the way down. And for the next 2 days, it came down $2. We identified the entry from the highest point before it came down. Now, this is in futures. You can trade over there, CFDs. You can trade crude. You can trade gold. You can trade the U.S. indexes. You can trade the DAX. You can trade the Nikkei. It doesn't matter. It's all the same principle. We're looking for that same imbalance of information. The Russell, this one's very clear. As you can see, this one, volume divergence was here in this candle, actually. And then, as you can see, they were always in the negative, always. Now, these dots are what I call the power dots. And when they come out, they literally announce three things: volume, momentum, and liquidity. And when that happens, you literally have, if you are trading in the smaller time frames, you literally have about an hour to 30 minutes to assess risk, go to higher time frames, and determine if you have multiple time frame confirmation in order for this trade to play out in your direction. That is something that most softwares out there don't give you because they don't provide this information. I'll show you that you can systematically and logistically identify each step before taking risk, entering your trade, and determining your outcome. Now, this trade came all the way, this one moved quite a bit actually. This one moved from 1142 to 1137. That's a 5-point drop. I got out here at 1138, so it's about 4 points for me, but I could have gotten out with 5 points on this trade. This next one is the Euro trade that I took this week. And this one, my entry was here. But here, see this candle right here? This one showed that it was bullish, and you can see how it was a bullish bar, but then it settled with a negative volume. So that means that this one this is a bullish candle with negative volume, and the body of the candle was completely separate from the point of control where the buyers and sellers had agreed to settle and bid and basically most of their business. This imbalance between order flow, price action, and volume divergence is the secret that they don't want you to understand. And there isn't technology out there that can actually show you this. And that's the complicated part about it, that, you know, this is information that is crucial now to your decision process. So this is on a 10-minute. So I got the signal here. I got in here. So that means that it was 1, 2, 3, 4, 5, 6, 7 candles before. So that was a whole hour. Why did I draw a line this way? Because what happened was this. These candles from here, from the very beginning, as this was going up, you had volume divergence going down. And so a very simple visual concept that when proven with the numerical values behind it can only make sense. So when these power dots came out, they were announcing the trade is coming. I knew it was going to go down because this one had already come down. They came back, retested the trend stop, which is an ATR level, and then it just pop, came down. Now, I use 3 moving averages. I'll tell you why. These moving averages are a 50, a 100, which is a gray, and the white, a 200. Very simple moving averages, gentlemen. You can use them yourself. What's the secret behind these moving averages? These are the moving averages that they are using right now to define their mean. So if you understand what mean reversion is, it means that they will basically trade away from the mean and trade right back to the mean. That's all it is. Economists have been using it for decades. The banks have now programmed them in such a way to actually confuse you because most traders use moving averages and moving average crosses. I don't. That isn't the purpose of this. It's so simplistic that it's actually upsetting when you find out what they're really doing. But this is it. Now, most of these are small trades, but I don't want you to look at them as small trades. I want you to look at them as how much time you had to determine if this trade was going to be your trade. Bottom line is that in each example, you had about an hour. That is a lifetime of information. This is one contract, gentlemen, one lot. So that means that if you know an hour in advance or 30 minutes what's going to happen, you can comfortably increase your lot sizes and really give them a whipping effect that they're not going to see coming, because now you can actually forecast 5 moves ahead what they're going to do. And that, to me, that is more valuable, because if I have time to determine my risk, my entry, and my outcome, then I have specific, measurable, attainable, realistic time goals that will be met. And that makes this a smart money trade. Excuse me. Our smart money trade analysis software provides the solution. Why? By using our smart money trade analysis software, you're getting cutting-edge technology that works and decodes the bank's market maker strategies. You can now look at the trade without any fear and doubt, because you have all the information to make a confident decision. You can stand and face their artificial intelligence with your own confidence and trade on your terms, not theirs. This is about trading on our terms, gentlemen. Nothing more, nothing less. We determine when we go into a trade. We determine when we are going to win. We determine when we have minimal risk or no risk at all. You're always going to have risk when you get into a trade, but if you minimize it to 95%, then basically you only have a 5% X factor. Now I'm going to show you one trade that I did yesterday, and this was right before non-farm payroll. And this was literally 3 minutes before. But what's important is that I was able to outline what was going to happen an hour before it happened. This is how the trade played out. Number one, I had power dots giving me a 2-hour window, letting me know that there was volume, momentum, and liquidity coming into play. I identified the trade on a 7-minute. Here's where I had volume divergence. This is the candle pattern that I was looking for. They were trading around the mean, which were the moving averages. This was a bullish candle with bearish volume. My entry was here. I had 2 candles that gave me the same signal, and every time the volume was diminishing to the downside. This was literally 3 minutes. I entered 3 minutes before the trade actually played out. I knew what they were going to do before the announcement came out. And this was the most transparent trade that I was able to find among all of them. I identified that the euro was going to go long, I identified that gold was going to go long, and I identified that the US yen was going to go short. But this was the most transparent trade of them all. Now this is 2 minutes before the trade, but you can see that we were already positioned and they had already began to come down. The trend stop, or the ATR level, was already going down. We knew what was happening here, that there was volume and liquidity momentum buildup. We knew there was volume divergence. We had identified an imbalance between volume, price action, and order flow. And here's the volume indicator, which basically identifies the volume, buy-sell volume as it's coming in. Now, each candle has a specific amount of volume in FX. Now, you can't really see volume in FX. We all know this. Well, we've created a method in a way that we've synthetically created it for you so you can see it. Now, you can see this video later on YouTube, and you'll see that we took about 5 trades. 5 or 6. 5 which we were successful, and the last one which we took a small loss of 15 pips. But we made over 100 pips trading. But watch this trade, and you'll see how basically 1 minute before they start to play. But look at the volume indicator here at the bottom. See how it's negative? It has negative volume. Slightly coming up, but no cigar. And then the announcement hit. This was right before non-farm payroll. No one out there trades non-farm payroll the way we do. They do not get into trades ahead of the announcement because they know that what will happen will be detrimental. We got out with 55 pips initially in this trade. It went down over 150 pips. Actually, for the day, it went down 211 pips total. I could have gotten out with 80 pips if I would have waited, but when I do the webinars, I show people that sometimes it's better to, take a quick profit and move on to the next trade. And that's what this was about. So at the end of the day, it came down to one thing: forecasting with the right information, because the decision had already been made prior to the release of information. And that's what this is about. So you can see this video a little later. I'll show you where it is in the YouTube channel. So again, now you can stand and face your artificial intelligence with your own confidence and trade on your own terms, not theirs. Why? Because there's no more fear and doubt blinding you. You will know exactly why things are happening and when they're going to happen. And that puts you in control, which is what you want. That's what will make you become a smart trader. You will become analytical of the real trade they are setting up to execute. You will no longer define yourself by your failure, but by mathematical facts that allow you to read through the confusion, to not be that slow, uninformed trader. Now you can trade on your terms, not theirs, because you will be in control of the wheel. You become an analytical of information because now you know the right information to look for in a trade. So your decisions are no longer slow. You're not, you're not as slow as a snail. You're not late to the, to the game. You're right in front of it. You're in control of the trade. And it doesn't matter how much information they're throwing at you, because you know exactly what you're looking for. That makes the difference. That makes all the difference nowadays. We're not using outdated information. We're using up-to-date information that they are using to determine their decision process, which is what we like and what we need. So this is basically my information. My website is phoenixtradingstrategies.com. You can go take a look at it. My email, info@phoenixtradingstrategies.com, ricardo@phoenixtradingstrategies.com. And on the weekend, I don't really look at my business email, so you can email me at Gmail, ricardomengero1@gmail.com. My YouTube channel, go to Phoenix Trading Strategies. You'll be able to see the latest video that we did, which was the one on non-farm payroll, which was yesterday morning. You'll be able to see the trades that we took. You'll see what my decision process was. You'll see that I was very systematic, very logistical, very metallic about getting into trades, and I knew the outcome. Why? Because they already told us what the outcome was going to be. And so at the end of the day, it really comes down to that. Can I show you what their outcome will be? The answer is yes. So I'm going to show you right now, excuse me, why I was able to confirm those numbers in the volume indicator. Let me expand this further so you can see the imbalance that I was talking about in that yen trade. This was that candle that showed that the sellers were all the way up here and the buyers were right here. This is an imbalance that you normally don't see, but it's very crucial. Why? Because if the sellers are willing to sell at a higher price and the buyers are not willing to buy at a higher price, then by nature, common sense, it means that the buyers are not going to drive this thing any higher. So at one point, this candle was green, and this actually reflects that. Why? Because this is a bullish volume bar with negative volume. Why is it negative? I'll show you right now. I'll put this right next to it so you can see. This volume bar, this candle had 31 million on the buy, 43 million on the sell, a difference of 12 million. Now, this is not $1 million trade, gentlemen. This is a $1 billion trade that is made by the banks because they use billions to move the market. And they use them, in this case, to do absorption trades just as much. I'm showing you in millions, but in actuality, these are billions that are moving this thing. This should be 3.1 billion. Why? Because banks quote $1 million a tick or $1 million a pip. So I'm showing it to you in basically a diluted version so that you can understand, so that it can be acceptable to the human mind. You know, when you see big numbers, they scare people. Even when you see millions, you know, it can sometimes throw you off. This next candle, as you can see, each candle, this one had bullish volume, 48 million on the buy, 23 on the sell, difference of 25 million. This next one, a bearish candle, bullish volume, 54 million on the buy, 40 million on the sell, difference of 14 million bullish, but it closed negative. That doesn't make sense. Next candle, 29 million on the buy, 34 million on the sell, difference of 4,500 negative. It was a bearish candle, okay? This one, bullish, 49 million on the buy, 33 million on the sell. And then finally, the one that basically said, take the leap of faith, which is this one. And this wasn't the one where I entered. No, I still had two more before I got into this. But this one had 35 million on the buy, 62 million on the sell. And, excuse me, as you can see, no body of the candle because it settled right where it opened, but it was negative. And then this one, of course, more or less balanced out, 51 million on the buy, 52 on the sell, difference of 300K, and that's why, because they throw in half orders. Sometimes they don't do $1 million a tick, they do a $500,000. But it was negative. It was a bullish candle with a negative outcome in volume. And then, of course, this one came down. And what was the outcome next? Our entry was, actually, this is the 7-minute, it was here. And then it came all the way down. We exited right here. So at the end of the day, you know, this trade ended up coming down all the way down. So it went from here all the way down here, 221 pips. I got it with 55. Believe me when I tell you, I don't feel bad. Why? Because there's always another trade. If I don't make 100 pips, it's okay. In one trade, I'll make it in 2 more trades. Why? Because every day, setting aside non-farm payroll, which is a very unique day that everyone trades the market, I can show you that there are 3 to 5 trades in the European session and in the U.S. session, and most definitely 2 to 3 trade opportunities in the Asian session when you trade Forex. And it doesn't matter what you trade. You can be trading futures, you can be trading CFDs, you can be trading FX. These algorithms that we've designed can be used to trade all 3 asset classes: Forex, futures, all 3 asset classes. Now, I don't use MT4 for my charting. Why? MT4, I love MT4. When I was a broker, I used to get people to use MT4 all the time, and I had great success with it. Why? Because it's a very easy to use platform, and I like it only and specifically just to execute trades. Why? Because it's easier to manage. NinjaTrader is a great platform because it allows you to look at the market from a completely different perspective. You're using a professional platform to now look at different time frames, a 7-minute, which no one trades at all, a 12-minute, a 20-minute, a 180-minute, a 120-minute, a 90-minute, a 45-minute. I look at time frames that most people would never even think of. Why? Because those are the time frames that the banks are using or the market makers' algorithms are using to really outline their trade. Now, once in a blue moon, they will come out in conventional time frames. And so that's why I use this. We created this market analyzer to basically put in all the instruments that we trade, from the 30-year bond, the mini futures, the S&P, the NASDAQ, the Russell, gold, silver, crude, the DAX, all the Forex pairs. And so when this thing outlines that power dots are forming, you pretty much get this light lit up. Now I have it on a 10-minute, but you can have it on a 30-minute, a 60-minute, a 20-minute, a 7-minute. It doesn't matter. I like the 10 and the 15-minute in the smaller time frames, and I like the 30, the 45, and the 60. But sometimes I may only be using one market analyzer. You can actually have 2 or 3 open at the same time. That's up to you and depends on the type of computer that you have. So that you can make comparisons between them. This is not a complicated system. It's very easy to use and very simple to learn. It takes me 30 days to train a person to master it. That's it. What normally would take you years to learn, I'll show you how to be ready to trade live in 30 days so that you can be in control and not the banks. And that when you trade, you're looking for a specific outcome, a measurable outcome, an attainable outcome, a realistic outcome with a certain time frame attached to it, so that you're not putting yourself at risk, but actually taking advantage of them. That's what this is about. Nothing more and nothing else matters except being in control of them. That's all that matters. So at the end of the day, really, it comes down to being analytical of the information and being in control of the trade. And that's where we'll put you. We'll put you in control of trade so you can face your fears, your doubts, eliminate them completely so that you're not confused by their math. Life is simple. Trading is simple. Gentlemen, I only trade 3 hours a day. And I average between 50 to 80 pips a day. That's it. I don't look for more because I don't need. Can you trade this on a higher time frame and leave it in position trade? Of course you can. I teach people to do it all the time. So at this point, I think we'll open it up for questions. Any questions so far?
Does this software work on MT4?
I couldn't hear that.
Yeah, it was he was asking whether it works on MT4.
No, does not work on MT4, and I'll explain why. MT4 has limitations. MT4 has minute data, not tick data. And so the algorithms need tick data in order to populate the information. Otherwise, it cannot work. I know that all of you like MT4, but if you want to, if you really, really want to beat the markets, I'm telling you, MT4 is not the platform. You can use it to execute your trades, but not to determine your decision process, because you're never going to get fast, accurate information the way I'm presenting it to you. It just won't do it. It's not built for it, and that's why it's free. Any other questions?
Specific brokers that
Right. So he's asking whether you have to go to a specific broker
Yeah, basically the platform is offered by NinjaTrader. So you can buy the lifetime license if you want, which is $1,000, or you can use their demo and basically just pay for their data feed, which is, you know, what some of my students begin doing while they start to make money. Then afterwards, they end up buying the license for it. So my software is a plug-in for it, but it's very easy to use. You know, you're not going to pay. There's two feeds that you can use on NinjaTrader. You can use, there's actually three for Forex. You can use their FXCM feed, which I find very slow. I wouldn't recommend it. I would be doing you a disservice if I said so. You can use their Kinetic feed, which is their institutional feed. It has 12 top tier 1 banks and one extra liquidity provider. Now that one costs $75 a month, which is a small investment. Believe me when I tell you, you'll make it in the first trade. Or one of my clients just basically made me aware that you can use AccuFeed as a plug-in into NinjaTrader, and it only costs you $30 a month, which is practically the same feed as their Kinetic feed. So for $30 a month to get accurate information, I think is, you know, not out of the question. I have someone that's asking a question. Let me unmute him 1 second. Hi, Shams.
Hey, hi, how are you?
Very good, sir. How are you, sir? How can I help you?
Excellent, excellent. Thanks for unmuting me.
No problem.
Go ahead.
No, do you have a question?
Yeah, I mean, I was just trying to understand, what would you recommend would be the best and the most comprehensive starting point with what is needed to get somebody started? I mean, there's all these options, right, that you're talking about.
Yes.
And what happens is, to most folks out there, as we have seen in the last 10 years or so, Ash and I have been, running Forex checks, is that what happens is most folks have come from such a diverse background.
Yes.
In terms of their experiences, the markets they trade, the maturity level they're in, and so on and so forth, that when you give all these options and talk in these terms, what we have noted is that everyone is confused.
I understand.
Right? So basically, if you could throw some light on something that's concise, something that says, okay, here's the 5 things that I would recommend would be ideal. That would be the ideal, and then you can get close to that with this. But this is what I would recommend based on my experience and the traders' experience that have been using the platform. Thank you.
So
I'll put myself on mute.
Okay, let me
I'll go back on mute.
Okay, great.
Okay.
So, gentlemen, it's very simple. Okay, look, I know that most of you have been trading for quite some time. If you understand support and resistance, if you have a basic idea of how candlesticks work, then I can teach you to trade. Why? Because if most people understand candlesticks, why? Because we use them all the time. You know, you don't have to have a tremendous amount of knowledge of price action, of volume price analysis. I'll teach you that. This is very simplistic. It's not complicated. What I recommend to some people that are new to trading is, if they don't really know how candlesticks work, then I tell them, look, go to Amazon.com, buy Candlesticks by Steve Nisson, his first book. It'll cost you maybe $50. That's all you need. You don't need anything else from him, because he doesn't know what he's talking about. He's so outdated, it's not even funny. However, his first book was and continues to be probably the best tool to learn how to understand and read candlesticks. Why? Because We all use them. Candlesticks are the foundation of our trade. I don't need you to learn what an ATR level is. I don't need you to understand how I use the moving averages. I'll explain that to you. It takes me, normally when I train someone, I will usually send out 3 videos to them, 3 training videos, which are 3 hours long each one. And I usually require people to view them at least 2 to 3 times. Why? So that when I train them, live, it will take me an additional 4 days, 2 to 3 hour sessions. And I walk you through each and every indicator. I explain to you what it does, what you should be reading, what you should be looking for. So you become very detail oriented in their trade. This isn't about your trade. This is about their trade. When we look at trading, we always believe, or many people have a tendency, and I'm not, I was one of them. I would say, the market isn't listening to me. I had a client say that last week when I was coaching them, and I was like, okay, let's go back to that statement. The market isn't listening to you. Do you know when someone says that, why they say it? Because they don't really have a complete understanding of what the market makers and banks are going to do. And they're looking at it from their perspective, which looks logical, but then the reaction of the market is illogical. And so what the banks have done is that they've created these illogical outcomes to confuse you. I will show you that you can read through that confusion so that you're not confused about it, because I will teach you how to understand the institutional mindset. Retail traders have a really hard time with that because they've never been told that or exposed to that, for the simple reason that you've never really worked behind the scenes. I was fortunate that I did. I started trading 12 years ago, just like you, as a retail trader, and then I became a broker in 2008. Why? Because I wanted to see what was happening behind the scenes that I couldn't understand, because I wasn't having success trading. I was winning, I was losing, I was winning, I was losing. How sound familiar? Winning, losing, and losing, 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 winning, winning, losing, losing, and you end up breaking even or losing, period. And most of the time it's more losing. That's why they say that 95% of traders lose, because they don't understand the market. And so we come up with these sayings that the market isn't listening to me. No, you're not listening to the market. I will show you how to be in the same wavelength so that you understand each motion that's taking place. So you're in the same mindset, same mind frame that they are in. So don't look at this as something that is beyond your limitations right now. It's not. It's at your reach. Literally right in front of you, gentlemen. This is information that will change the way you trade forever, that will give you an edge, and that information that you can actually count on, because it's all mathematical. You don't need to do the math. Now, if you can add 1 plus 1 and 2 plus 2, that's all I need you to do to understand the volume indicator. I will show you the rest. I will take you by the hand and lead you to the other side of the street so that you don't get slaughtered and killed by all the traffic in the road, because that's what happens to most retail traders. We look at things from a perspective that cannot be implemented into the market anymore. They've counter-programmed a lot of indicators that you use. You're using lagging information. It's just not working for you, and that's why you're not getting the results. All right, question. 1 second. Go ahead.
Yeah.
Hi, Arun.
Yes.
Just go ahead.
Yeah. Regarding I saw your presentation.
Okay.
The thing is, the system focuses greatly on the entry point in a trade, right? But sorry, please forgive me if I overlooked or missed it. But I don't really see where to exit. As a professional trader, when I enter a trade, I want to maximize my profit. When it's a profitable trade. So,
I'm, excuse me. I'm sorry. Can you repeat that question? Forgive me. Can you repeat that question?
So, yeah. No, it's coming.
Hey, Kamal? Kamal, can you hear me?
Yes, I can.
This is Chance. Listen, could you do me a favor? Could you just ask the questionnaire to just let everybody know the name so that Ricardo and I, who are not in the conference, can understand who's asking the questions, who's speaking.
Right.
Thank you. Thank you.
Can you repeat the question again, please?
yeah, hi, Ashish.
Go ahead.
Yeah. So I want to know, you're very specific about where to enter, when to enter, the time period and everything.
Yes.
I get it.
Okay.
But as a professional trader, when I'm trading, I like to maximize my profits. So if it's a profitable trade, I
Yep.
want to, make the most. So I need to know where I need to exit, the
Oh,
closest
yes, good
state.
question. Very good question. So basically, there is part of the system which basically identifies these levels. These magenta dots that you see here, these are pivots. Now, I show you these pivots now because these pivots are very significant as to retrograde analysis. Why do I say retrograde analysis? Because when you're in a trade, you're going to be looking to the back to see what the next levels are. So as they penetrate these price levels, they'll go to the next one. And if they break through that one, then they'll go to the next one and on. And so if you're looking to maximize your trade, for instance, this trade was identified not only in the smaller time frame, but also on a 60-minute and a 45-minute and a 180-minute. So I will show you how to confirm, once a trade is defined in the smaller time frames, how to look into the higher time frames to determine if that same pattern is forming and if that trade has an hour of life or 2 hours of life. And based on that, and same thing in the higher time frame, if you're looking to trade, if you're looking to, to position trade for 1 or 2 days or even a week, you can apply the same principle. So maximizing the trade potential is really normally what I show people is that when you're in front of a trade and you're up 50, 60, 80 pips, this is what happens. You get emotional. Human nature takes place. And so you have a tendency to basically not let the trade develop and evolve even further. And so you'll take a profit. Why? Because the minute that they start going against you, let's say that you're up 60 pips and then suddenly they go up 10 pips, you wait a minute, I don't want to give up what I already have. So put a trailing stop and walk away. Literally put a trailing stop and walk away. If you can do that, the trade will develop even further and you'll be able to maximize, a much better outcome. I have traders that will literally take this trade and literally milk it for every pip. I was trading NFP, and at the same time, by trading NFP, it's a very fast market for that day. So when I saw this trade, I said, I'm here to show how my technology works. So I'm going to take this trade, I'm going to book it, and then I'm going to go look for another one. And that's what I did. In the video, you'll be able to see that we took 6 trades total. The first 4 were all profitable, no questions asked. Some trades that probably you would never even think of taking. I will show you how to find and identify those trades so that you can see when it is time to enter and when it is time to get out. This is part of the learning process. And so This takes time, gentlemen. Believe me when I tell you, I will get you ready in 30 days to go live. 45 max. And I mean max. I have had clients that I've trained that literally a week after I train them, after they go through the month process, they have made their investment back in the software. So believe me when I tell you, what you're seeing is a very, very, very simplistic format of what you're going to really live when you use this software. You're going to enjoy trading because you're not going to fear it. And when you start to consistently win, because that's what this is about, consistency. And even if you have a losing trade, your risk is never more than 5 to 10 pips. And you can actually quantify that. You'll see most of the trades that we took in this in this video and in others, we never risk more than 10 pips. 10 ticks max. That's it. That's our risk. And if we lose in a trade, we make it right back. So the reason we make it fast is because we understand what the market's doing. Again, you know, we're trading based on probabilities. That's what this is about. But the probabilities are in your favor. Anything else?
Anybody, any questions? Does it work with Renko or range bar charts?
Yeah, the question is, Sunil, he's asking whether it works with Renko or range bar charts.
It does. I don't use Renko. I do have clients that use range bar charts. I think with if you're using Renko, it's a matter of perspective. I don't like using Renko. That's just me. Can you use it? Yes, you can. Can you use it with range bar charts? Yeah, you can use it with range bar charts. I'll show you that you don't need to, that this is very simplistic. You don't need more than candlesticks, believe me when I tell you. Anything else?
Anybody else? Okay.
All right, so let me stop the recording for a second.